So the problem you have is that UK property tax are going to significantly change and means that you pay more taxes in the future. And the idea behind this video is to help you understand how you can minimize tax on your property portfolio, which means that you should keep more money in your hands. I'm Simon Mashevich from Optimise Accountants, and in this video we're going to help you do exactly that. You can see our website appearing on your screen just now. Now, if you want further advice and support, then feel free to download this book, which you can help you save even more tax by getting more. Please use the QR code shown on your screen right now. So the problems you face. Landlords can deduct expenses that are wholly and exclusively for the rental business, thereby reducing taxable income. These expenses include general maintenance, repairs, utility bills, insurance premiums, and professional fees. Accurate record keeping is essential to substantiate these deductions. I've seen time and time again where landlords say, I've had the expense, but I can't find the invoice. Well, if you can't find the evidence, HMRC have every right to take away that cost, meaning that you have potentially underpaid taxes and they will charge you fines, penalties, and interest for that item you cannot substantiate. So here's a classic example of a refurbishment, and you'll see here that you may have to do some repair work for any broken items, replacement of the carpet, the walls, the fireplace, and you may then do some redecoration. Notice the words I'm using: replacement, repairing, redecoration, repainting. Why am I using those REs? Not to be annoying, albeit I'm sure it sounds like I'm being annoying, but the idea behind it is that RE does stand for religious education. You'd be pleased to know. RE basically means that you can offset those costs against your rental income. Here is another example. That beautiful kitchen on the left-hand side is where you're aiming to get to. Oh no, wait a minute. It's on the right-hand side. Of course it is. So if you have the property on the right-hand side, you are likely to get greater rental income. And that is the point of this slide. It's talking to you about a refurbishment works that has to be offset against your rental income because it helps you generate more income. It's a business activity going on here. You are replacing, again, please note the emphasis here, of the kitchen, the repainting of the walls, and typically any repair work that you might have to do on the windsills. So let's go into a bit more details. What can you offset against your rental profits going forwards? Well, the first thing is 20% mortgage interest. You are no longer able to offset the totality of the interest. You can only offset the 20% tax deduction. So you won't be able to say, here's my income, here's my mortgage cost, and then I've got the profit. No, that doesn't exist anymore. You have the income, then you have a 20% tax reducer on the mortgage interest cost against the profit. Sounds confusing, I'm sure, but for many of you who've been doing this now for many years, you're probably used to this. Service charges such as letting agency fees and maintenance can all go against your property income. Repairs we've spoke about before. If you've broken anything, you need to repair it. It can be offset against your rental income in full. Replacement, bathrooms, kitchens, as we talked about, and then finally repairs and renewals. If you're going to be replasterboarding, then repainting, all of that can be offset against your rental income. But how do we know that? How do we know we're allowed to do this? Well, if you Google HMRC, repairs, replacement, renewals, it will bring up some nice legislation for you to read even further. But if a property is in a lettable state, HMRC's own page says if it's in a lettable state, it can be allowed for tax purposes. And if you have a buy-to-let mortgage, what is the condition for this? It needs to be in a lettable state. So therefore, you can offset quite safely those costs I've just mentioned against your property income. But again, please do keep your receipts to make sure that they're all allowable. Some of the things you need to think about is, do you actually have your repairs, your replacement, your renewals, against your rental income, or do you have it against your capital gains tax? Now, you may think, well, I don't have much of a tax liability on my income by having this property. Therefore, what's the point? I'm not going to be paying too much tax, so I may as well keep it until I sell the property to help me reduce my capital gains tax. It is a choice. It's one or the other. It isn't both. And again, do not lose the relief. Just because you are not going to offset it against your rental income now, don't lose the receipt, please. So many times I'm doing capital gains calculations where people cannot find invoices, and it means they cannot take that cost. And means, of course, you pay more tax. For anything else, please use the QR code and get some tax advice to help you minimize taxes. I'm Simon Mishevich. Hopefully that's been useful. There's a website, and do watch that video at the bottom. Avoid the 5% stamp duty, because it will help you understand what the new 5% stamp duty rules are and how you can legally minimize that